Right now, property investors are making one of two decisions with their portfolios. They're either walking away from UK property completely, or they're mobilising funds for reinvestment while everyone else is distracted by the headlines. And the differences between those two groups? It comes down to understanding what actually drives property returns. I've spent 20 years as a UK property consultant helping investors from across the globe navigate market shifts and assisting them directly with securing UK property. And Select Property have completed over £3 billion in sales since 2004. So we've seen multiple budget changes, tax reforms, and market cycles. And what I can tell you is this: the investors who react to headlines without understanding fundamentals almost always regret it. And the investors who underestimate the long-term stability and strength of the UK property market almost always miss out. So in this video, I'll show you the 4 fundamental factors that determine if UK property still makes sense or not. Number 1, capital growth. Let's start with the foundation of any good property investment. A lot of investors look at UK property charts and they're disappointed. They don't see massive spikes or dramatic jumps. They want the excitement of a market that shoots up by 30% in a year. So they assume steady, gradual growth means the opportunity isn't there. But here's what 20 years in this industry has taught me. Those dramatic spikes are usually followed by dramatic crashes. Yes, you may time it right and not be at a loss. You may even make incredible returns, but these kinds of markets are high risk, and what you set up to gain, you could just as easily lose. The UK property market doesn't work like that. While there are similar spikes and dips, ultimately, it trends upwards consistently and reliably over the long term. That steady climb you're seeing isn't boring, it's predictable. And predictable means you can actually plan your financial future around it. Historical performance has shown long-term capital appreciation. Even through recessions, political uncertainty, and global crises, the overall trajectory has been upward, meaning investors' returns only tend to increase and get stronger. Arguably, it might be sensible to stop chasing the excitement of volatile markets as they carry much higher risks. Certainly, it's wise to at least balance and diversify your portfolio to cover the potential risk. If you want stability, security, and reliable growth that you can count on for your retirement or your children's future, UK property is still delivering that, and the forecasts show it will continue to deliver that for years to come. Now, because capital growth is only powerful if it actually fits your personal situation, we've created a quick investor readiness quiz. It helps you figure out whether UK property makes sense for your goals, budget, and timeline right now. You can take it using the link in the description. Number 2, financing the purchase. Growth only matters if you can actually access the market, and many believe financing isn't an option. Many investors, especially international buyers, still believe they can't get a mortgage in the UK. This simply isn't true. UK mortgages are available for both domestic and international investors. Lending rules have adjusted, and many buyers can still enter the market with structured deposits and repayment plans. Always speak to a specialist mortgage broker early. Never rule yourself out based on assumptions or online chatter. Recently, UK mortgage rates have begun to drop, presenting a more favourable market for investors as well. Number 3, rental yields. For an investment to be worth it, you'll want to see regular, strong returns. Property investment in the UK offers that, particularly in city centres. Demand from young professionals continues to push the rental demand in the city centres to surge, where supply is limited. For cities such as Manchester, Birmingham and Leeds, where there is a strong number of graduates and a large desire to live and work directly within the city centre, accommodation is competitive, meaning rents keep rising. One undeniable example is Manchester, where rents for new build apartments have increased by over 50% over the past 5 years alone, and it hasn't reached its peak. In fact, it's set to rise even further. Take a look at this data from leading researchers JLL. Over the next 5 years, Leeds is set to see rental growth of 17.6%, Edinburgh 17.6%, Bristol 18.2%, and both Manchester and Birmingham an impressive 18.8%. The UK as a whole will see an increase of 17.1%, with all these leading cities set to enjoy the most growth. UK rental yields are strong, but they haven't peaked. They're only set to increase too, as demand rises at a rate supply simply can't keep up with Birmingham, for example, required to build over 100,000 homes over the next 10 years just to try and keep up with demand. The UK offers regular returns at a strong rate few other countries can compete with. and this growth will likely only continue. So, how can you benefit? Target investments in cities with strong job growth, universities, and transport infrastructure, not just investments with attractive entry prices. Number 4, the unshakable demand. People assume demand is cooling because headlines say the market is slowing. The market is in fact ramping up. With the autumn budget out of the way and the property sector remaining largely unchanged, global investors are turning again to UK property as a smart choice for their capital. The UK remains one of the highest demand real estate markets in the world. Domestic demand is driven by population growth and limited new supply. International demand comes from investors who see the UK as a safe, rule-based, mortgage-friendly market. The UK has a robust legal system with strong transparency and rights regarding property ownership as well. Deposits and down payments for UK property are also often lower than in other countries, presenting a more attractive entry into the market. This combination gives UK property a level of stability you just don't see in more volatile markets. My advice to investors is to follow where institutional and international capital is moving. That's where you'll find the strongest investments and the best returns. Now, knowing the fundamentals is one thing, but choosing the right property at the right time is something completely different. And that's exactly why we offer direct support. If you'd like personalised guidance, get in touch with us directly and we'll help you find the most suitable opportunities for your goals. So now you know the truth. The UK property market's steadiness doesn't mean it's dead. It means it's reliable, consistent, and growing at a realistic pace that will protect your capital. And if you want clear updates on the UK property market and real guidance you can actually use, make sure you subscribe because we've got a full range of in-depth property guides coming your way.